Hi, my name is Ryan O'Neill. I'll be talking to you today about Chapter 4, Income Statements. First question I developed is, what is the use of an income statement? It presents a summary of the company's revenues and expenses over a period of time. The second question was, name 5 components of the income statement. Those obviously are revenue, expenses, operating expenses, cost of goods sold, and net income. There are more to this, but those are just some 5 main ones. What is accrual concept? Accrual concept records the revenues when they are earned, not when they are paid. They can be recorded when they are paid if it is paid on the date that it is earned or sold. This is a great technique for businesses to monitor their cash flow and see where everything's going and help you make better management decisions uh, other than the cash basis accounting system, which we'll get into later. The fourth question is, what is revenue? It is earned with a company through goods and services performed and goods sold. What are expenses? Expenses are expenditures made to generate revenue for the company over a period of time. 6 is, what is net income? It is the difference between revenues and expenses for a specific period of time. The seventh question is, interest and income statements are used how? They're subtracted from the revenues and expenses before determining the total net income. Sorry. What are bad debit expenses? Question 8. Bad debit expenses are the allowance debit that will not be able to be collected in the time needed. So if they say that they'll pay you on December for something they bought in July and they don't come through, say the company goes belly up that bought it from you or something of that nature, that bad debit expense allows for basically a bumper cushion for money that's projected to come in but won't ever. The ninth question is to name the transactions that affect the income statement. Those are sales, cost of goods sold, gross profit, and operating expenses. The 10th question, what effect do sales have on income statement? Sales have 2 changes on the income statement in the revenues and expenses. Obviously, when you buy something and you sell it, it's going to increase your revenue. But then the expenses to what you paid for that item to be sold or what you pay your employees to perform service uh, or even to restock the goods sold. Question 11 is, what is the difference between cost of goods sold and gross profit? Cost of goods sold is the cost of all the inventory in a period of time for the income statement. Gross profit is the difference between revenue and cost of goods sold before operating expenses. Sorry.